a month. And you're paying that for the next 30 years. So you already know that's what you're paying, whether you rent out no rooms, rent out 1 room, 2 rooms, 3 rooms, 4 rooms. You know what the cost is, a minimum of $1,000 a month for the mortgage, right? Life insurance is the same way. When you buy a policy, you have, let's say this is the life insurance policy. You have a maximum premium, and then you have a minimum premium. Okay. Now the life insurance company sets the minimum premium. And if you guys think about how brilliant this is, a lot of people don't look at it this way. But what does a life insurance company sell?
Money.
Yep, they sell money. Now the question is, how much does the money cost? Well, that's going to be different based on your age, based on your health, et cetera, et cetera, et cetera. So the insurance company is calculating how much money they need to minimally collect to be able to insure you for, let's just say, 500 grand. Let's say the minimum is 1,000. So what do most people do? They pay the minimum, right, of 1,000. They just pay for their insurance. Now, the maximum premium is set by the IRS. Anybody care to guess as to why the IRS would even care how much money you would put inside of a life insurance policy and why they would have a maximum?
To control us.
Yes. Yes. Yep. What does the IRS collect? Tax revenue. What was the first rule today? We got to put our wealth in the proper what position? Proper tax position. Life insurance is one of the only, there's only 2, one of the only true tax-free, I can't say investment, accounts in the entire United States tax code. Before 1982, there was no regulation on how much money somebody can put into a life insurance policy. But you know, wealthy people, they know how to get that bag. They're gonna get to it. And they said, hey, you know, there's this cool little insurance policy we can get and grow our money in tax-free. IRS seen that, they came and shut it down. They started regulating. So now that you have a maximum that you can do based on the death benefit. Got it? So let's say that the maximum for this policy is 10 grand. So this person can fund anywhere between 1 grand and 10 grand, right? 1 grand is the minimum, 10 grand is the maximum. Anything that they put in over the maximum is going to compound. It's going to grow interest. Typically, that interest rate is about 7% a year, tax-free, right? Now, if you do this right, you end up creating so much compound interest that the money you make covers the cost of the policy. It's almost like if you rent out 1, 2, 3, 4 rooms, you're going to make money, more than enough money to cover the mortgage. You're going to make a profit off that. Are you guys tracking me? So that's what we're looking at. We are maximum funding. We are overfunding a life insurance policy because we're taking advantage of the tax-free benefits. Got it? All right.
Can you run that back one more time? Because I thought it was a max. So I thought they're capping you, you know, as far as how much you can put in. So how are you able to put in? How are you able to overfund it?
Got it. So check it out. If you bought a multifamily, a 4-bedroom house, or not 4-bedroom house, a 4-unit multifamily, how many rooms could you rent out? It's not a trick question, right? You can only rent out 4 because it can only take 4. You can't put an extra person in a 4-unit multifamily property. So the same way in an insurance policy, let's say the death benefit is $500,000 and the maximum premium is $10,000 a year, then you can't put in any more than $10,000. You can put in less than that, but you can't put in more than that or you create tax consequences. Got it? So when we say we overfunding it, we're basically trying to rent out each unit, if that makes sense. Did that make sense, or do you want to try it again? Am I frozen?
No, you're good. We're just maximizing the policy as far as the 10,000 allowed. We're going to reach that maximum amount allowed by the IRS to make sure that we're accumulating as much cash as we can with this compounding 7%.
Right. Exactly. Appreciate you, Ant. Okay.
So,
now to get back into the numbers, okay, because I want to show you what this is going to look like, let's say 20 years from now. All right. And so what you see, just to recap. So Kenny's going to put in $60,000 throughout the year. He's going to take out $48,000 and he's going to save $12,000 in the account. Okay. Remember, our net cash value is the premiums we paid minus our loans that we took out, minus our fees, plus our credit that we made. That's the net number left over. And you'll see that we in the negative in year one. And that's because we got the fees for the insurance. All right. But what you'll see is as time goes on, these numbers get closer and closer. So let's say we get down to here year 7. At this point, Kenny has paid in $84,000 into his account, and he's got about $84,000 net of all fees, all loans, right? So what does this mean? Kenny is now broken even. Okay. It's almost like when you, let's say you put a down payment on your home. So you put down 20%, you got 20% equity in it. And if your house appreciates another 20%, you got your equity plus the money back. All right, so he's breaking even. Okay. Now at this point, Kenny's policy is called fully funded by his 7th year. So he just funded a life insurance policy, something that he's going to have for the rest of his life in 7 years. Okay. Now he's no longer going to save any more money in here. Okay. No longer going to save any money. He's going to treat this almost like a person treats a checking account, meaning money's going to come in, money's going to come out, and he's going to spend it. So what you'll see beginning in the 8th year is that Kenny's putting in 60 grand or his $5,000 a month, right? Remember that's how much his bills were. He's taking out $5,000 a month, which is how much his bills were, right? Now remember, when the money goes in, he's earning about 6% compounded interest on that. As the money comes out, it only costs 4%. So if you got money in one account making 6 and borrowing money from another account at 4, how much are you making or how much are you losing?
You said 2%. 2%.
2%. So you guys remember that 3% I showed you on your expenses a while back?
Right.
This is where it's coming from. This is going to be the benefit. That 2% interest is actually growing the net cash value of this account, right? As you see, Kenny is no longer saving any money in the account. He only put in $84,000.
it's like he might have froze just a little bit, but yeah, he's only going to save 84,000 into the account. And as you can tell in this cash value, it's going to increase year after year after year as we just put our expenses through the account.
Yeah, I told y'all my computer is messed up, man. I got to get a whole new MacBook. Wait, can y'all see me? Nope. I can't even see y'all. Hopefully my screen comes back on. Let's pause for technical difficulty. But while we pause for technical difficulty, does anybody have any questions?
I just want to make
Oh.
Go ahead.
Are you saying on the 8th year you ain't gonna have to put no more money in, or you gonna have to still make the $60,000 deposits every year? That's what I want to know.
Okay. So let me ask you a question. Because our words are important, right? It's all important. I'm just trying to make sure that we connecting the right dots. So when you say, do you still have to make the $60,000 deposit? Do you mean, do you still have to put in $60,000 a year? No, you don't. But if you have $60,000 a year and you have an account that you can make about 3% a year interest on that, if you pay it into it, would you pay it? Exactly.
Okay, all right.
So you never stop paying this account as long as you paying your bills. As long as you're making money, this takes paying yourself first to the whole nother level, if you think about it. Right? We just talked about what's our number one asset. Our income. Actually, our life is our number one asset. If we don't wake up tomorrow, then what? Right? So our life is number one asset, right? And we use our life to make money. And we do that by our job. We create income, right? So we're taking life insurance and we're taking our income and putting all of it inside of the account. We're paying all of that money to ourselves. And then we take a loan against our own money to pay everybody else. I know it's kind of backwards. They don't teach you, like it sounds retarded to borrow your own money and pay interest to do so. But I want you to think how smart that is at the same time. Okay, hold up. I might be able to log back in here.
I feel like there was another question out there.
There's another question. Yep.
I have a question.
Yes.
Based on that, since you're taking out the money to pay out yourself, is it every month or is it something annually that you have to do to take out the money to pay out yourself?
It could be either or. It could be weekly, monthly, annually. It really just it doesn't matter. We just have a maximum number and then we have a minimum number that we want to fall within. Right now, how you put the money in and how you take it out, that's really up to your discretion. It's literally just like a checking account or a savings account or a crypto account. You can add money as you see fit and when you see fit. That's a good question. Good question.
Thank you.
Okay.
Was there any other questions?
I am trying to get into the. Oh, I think I might be able to
I'm surprised we didn't get the main question
get.
I know Lee has a question.
Let's hear it, Lee.
Where's Lee? Or Lee?
I'm here, Christina.
Hey, Lee, you want
I
me to ask?
forgot. Remember you wrote it down?
Oh, yes. Okay. All right. I'm going to ask the question for Lee. So the question is, the money that you borrow from your policy, when do you pay it back? I think I structured it the right way.
That's the famous question I was waiting for.
That's the one. Yeah, this is where everybody gonna get off like, nah, y'all, man, you brought this dude to our Zoom and he over here telling lies and stuff, saying that, yeah, that if I do that, y'all might not believe me, but it'll make sense. It'll make sense. Let me ask everybody a question. If you had a house, right, and say you had some equity in your house, and times got hard, or not even times got hard, you needed some money to start a business. My question is, could you go to the bank and take a loan against your house for the equity?
Yes.
Yes. What happens if you don't pay it back?
Foreclose on property.
They foreclose on a property and they take the asset, right? Now in life insurance, remember I said we buying money? It's an asset. So let's say you borrow money from your life insurance policy and you don't pay it back. What does the life insurance company do?
Discontinue the policy.
Close.
That is one way.
That could happen. That could happen. But what would happen is, remember, the insurance company owes you money.
It's paid off.
There you go. Right. So remember, in Kenny's example, he had an $881,000 death benefit. That's money that the insurance company owes him. So if he took out $48,000 as a loan, he's still technically in the positive, right? Because he paid already for money at a future date that the insurance company owes him, contractually owes him. So if he borrows against that asset and decides to never pay it back, then they can say, you know what, Kenny, you know, these loans that you took out over the last 50 years, we're just gonna take those loans off of the death benefit that we owe you. We're gonna give your family what's left over. How's that sound? Kenny's gonna be like, great. That means I get to use my money while I'm still alive. Everybody say, wow.
That's very powerful.
I'm still having technical difficulties over here. I might be able to, let me try to do it another way, but I won't be able to draw if I do it this way. So actually,
You might want to repeat that again. You could borrow money while you're still alive. Ain't that right?
Oh yeah. Hey, we do it from ourselves all the time. How many people have put money in a savings account? Something came up and you say, "Hey man, I got to take this money out of my savings account, but I'm gonna pay it back." Everybody do that all the time, all the time. Now the question is like, how do you create leverage? How can I create $1 million worth of leverage? Right? Everybody on this call has made $1 million. Everybody. How much have you kept? How much are you still getting credit for? Right? So it's deep to think about.
Yeah, the difference is that we made all this money and we didn't know you just yet. So now when we make this money, it's gonna actually make money for us. So thank you.
Oh, you're welcome. You're welcome. You know, I'm just sharing what I know. If somebody never told me, then I wouldn't be here telling y'all. That's just how it is. You know, each one. All right, so I'm gonna just try to pull up because my laptop is not acting right. So we just gonna do it this way. I won't be able to draw, but at least you guys will be able to still see the screen here. Oh shoot! What I just did. All right, are we good? Okay. All right. So quick recap. So beginning in the 8th year, Kenny's not going to need to save any more money in this account, but he's still going to continue to pay the premium. He could also pay more than $60,000 at this time if he wanted to, because of how this policy is designed. But we're just keeping it simple, showing him put in 60. Also taking out 60, not saving anything, right? We're going to fast forward now to the time Kenny is, we're just going to go all the way down to his 60th birthday or his 60th year. At that point in time, this is Kenny's investment, the $84,000. This is the net cash value, meaning how much cash he has access to use however he sees fit. Meaning, Kenny's like, man, you know what? I need 500 grand just because I want to go blow it somewhere. Then he could do that if he wanted. But he likely won't, but he could. Okay. So my question to everybody is, do you guys think that we grew Kenny's money from $84,000 to $900,000 in the last 24 years because we were making 6% on it? Or was it because we were making 2% on these $60,000 of loans that he's been taking out every single year, which at this point in time total almost $1.4 million of loans that he's taken against himself or against his insurance policy? Matter of fact, let's just take a snapshot of just this year. And let's just pretend that Kenny got 6% interest on $84,000. How much money would that be? If y'all can help me out with the calculator.
$5,040.
5,040? Awesome. Now, if we can get 6% on $1,356,000, what's the number on that?
$81,360.
81,000. Oh, that's a big number. How much? Oh, I'm sorry. 2% on one. I'm sorry. I told you 6. Let's get 2% on 1,356,000.
27,120.
Got it. So in Kenny's year, At 60 years old, Kenny made $27,000 on money that he spent a long, long time ago.
Last 24 years.
Whereas he only made $5,000 on the $84,000 that he spent, or that he saved. I'm sorry. So that's how important leverage is, right? Can you guys see that? Like the big, even though it's a smaller amount of interest, it's on a much bigger number. You see? All right. Now, at this point in time, Kenny's going to start using this as retirement income. Okay. And I want you to notice that his premium goes from 60,000 down to 36,000. And so that's a little bit unusual because typically when people go to retire, that means they're not working anymore, which means they don't have income. And if you have a retirement account, you definitely not put money in your retirement account when you retire. That don't make any sense, right? But for some reason, Kenny is still paying $36,000 a year. My question is, why? Who wants to guess as to why he's paying $36,000?
At this point, he's investing.
Mm-hmm. I like it. I like it. I like it. He is investing. You're absolutely right. He is investing. Okay. Now, let's just rewind real quick. Okay. And let's assume that Kenny's income doesn't change and his expenses never changed at all. Like it's all stayed the same. If he comfortably was able to save $12,000 a year up to this point, wouldn't it be like safe for us to assume that he could continue saving $12,000 a year? Assuming nothing changed, right? Yeah. Well, just because he's not saving the $12,000 here doesn't mean he's not saving the $12,000. Maybe he's saving the $12,000 in the Carbon AI account or something like that. You see what I'm saying? But what it was it don't matter where he saves it. The point is that money is going to be able to be put to work somewhere else for him. That's going to create another stream of wealth. Isn't this seven ways of wealth? In that our group here? 7 ways of wealth?
Most definitely.
Yes, sir.
Okay.
Yes, sir.
7 ways of wealth. Well, this is
That's
just
the
one
goal.
way. Right? This is just one way right here. So after this was funded, he's going to create the second way, and then the third, and then the fourth, and fifth. And this is literally going to sit at the center of everything that he does financially from now until the day he dies. Now, I might have there we go. All right. Wait. All right, my computer's back up. Perfect. Stop. I'm back, y'all. Here I am. Okay.
We're glad to see you back, Brandon.
I don't know how much longer we got, so I'm gonna try to get it out, get it done before this thing shut down again. All right. So basically, what's happening is Kenny's taking $36,000 of income from another stream that he created, right? Another stream. And before he spends that money, he's like, you know what? Let me just pay it in here. So he's putting in $36,000, but then he's taking out $186,000. So that's the 36 he put in, plus an additional $150,000 of tax-free income that he's taken out from the cash value that he grew throughout this other time, throughout the lifetime of his policy, right? And assuming he only took out $150 a year, he'll be able to do that from here until here. 96. It actually goes all the way longer than that, but most people don't live much longer than this. You know what I'm saying? All right. Now, assuming he lives till 96, he would have taken out $5.316 million of tax-free income. He'd be leaving behind almost $11 million as a tax-free death benefit. Okay. And this is what he invested. $84,000. That's what he saved. That's what he saved. And he did it in 7 years. All right. I always make this joke. People are like, well, how much does it cost? All right, well, look, it costs $5.3 million not to do it. That's to be real. Because remember, all this money that he took out, this $1 million, he was gonna spend that anyway and get nothing. Nothing in return. You see what I'm saying? Now, that's Kenny's policy, but we can't forget about Michelle. All right. Now, Michelle's policy is just a little bit different, a lot of similarities, right? I want everybody to notice that she's also putting $60,000 of premium in her account, and Kenny's putting $60,000 in his account. Who remembers how much money they made as a couple?
90.
90. Okay. So I'm not the best person at math, but as far as I know, 60 plus 60,000 and 60,000 is 120. And if they only make 90, then that means $30,000 coming from somewhere. Okay. All right. Now, y'all remember when when the pandemic hit, the Federal Reserve was like printing money, and it was like, man, how are they creating this money? See, money is just created. It's just an idea, and whoever came up with this idea, I gotta give them their flowers, like straight up. Okay, because y'all really ain't gonna believe what I'm finna show y'all. So, okay, so here's what's happening. They have their bank account, and here they have their bills. Kenny has a policy. Michelle has a policy. They're taking income from their bank account, and they're paying Kenny's premium of $60,000 a year. Remember, they're going to take out $48,000 and pay their bills with it. But before they pay their bills with it, guess what? They're going to fund it into Michelle's policy. She's going to add her own $12,000 of savings. Remember, we had her stop her 403B contribution. Is she going to save it here now? Right? They're going to then take that $48,000, put it back in their bank account. Then they're going to use their bills, pay their bills, if that makes sense. Y'all got it? So it's the same money. So what's the benefit there? Well, if you remember, Kenny's making 2% as that money flows through his account. Now Michelle's making 2% on the same money as it flows through her account. And we got permanent life insurance for both of them. Both of them. Okay. Now, if we're looking at the long-term picture, okay, you'll see we're doing pretty much the same thing, 60,000 in, 48,000 out for the first couple of years. Then we kind of bump hers up a little bit because she got a really good rating here. So we kind of ran it a little bit lean. And just lean means we just super minimize the savings in it, just in case. All right. The beginning of her 8th year, we're going to flow that same 60 from Kenny's policy. All right. Everybody remembers that Kenny's policy premium went down to 36,000 and he pulled out 186. Well, guess what we're going to do with Michelle's policy? We're going to increase her premium from 60,000 to 186, the same amount that we pulling out of Kenny's, and then we pulling out 350,000 a year, tax-free for the next 30 years until they expire. So assuming she lives till age 96, she would have taken out $5.8 million in tax-free income, and she's leaving behind $20 million as a tax-free death benefit. Okay. How much did it cost them?
I have a question.
Yes.
I have a question. Okay. Maybe I'm being too technical because I like to see every breakdown. So when they pull this money, you're saying they're pulling this money out of their saving or directly from their checking? Because if I understood from before, it's not a life insurance through their job. It's their own personal life insurance that you purchase outside of the job.
Yes.
Right. So if they're pulling it out, this money that they get, like me, I get a check every month, every 2 weeks. So that money, the more money that basically I'm being paid is more money that's being taxed. So are they paying for that tax on the back in the front end when they, I don't know if I'm making any sense of it. Basically, how are they able not to get taxed so high on the front end when they get paid every 2 weeks?
From the insurance, or just not taxed like from your personal income?
Okay. So for example, some of us get paid every 2 weeks. And from that money we get paid, or whatever, it's whatever left after is tax. So once that money is, that's our money, and we put in our checking, our saving.
Mhm.
That's the money that they're pulling out every month to pay their life insurance, or
Yes.
okay.
Yes. Mm-hmm. Yeah. So
Okay.
yeah, they're taking his money. So like if you had your paycheck, here, wait. So all right, so you got your gross pay and then you got your net pay. So let's say if you had like a 401k, that means money coming out of your gross going into a 401k. So that means it hasn't been taxed. Right. Now our net pay, we already pay the tax here. So we put it inside of this is called an IUL, Index Universal Life Insurance Policy. All right. Once it goes in there, because we already paid the tax and because it's inside of an insurance contract, then we don't have to pay taxes on it again. Got it. Now, if this money was going from net into crypto and that money grows, we got to pay taxes on the gain of the crypto. If that money goes into stocks, right? We got to pay taxes on the gain of the stock. If that money goes into gold, silver, like anything outside of that, then you got to pay what you call capital gains tax. Now, the good thing is capital gains tax is lower than income tax. Okay. Income tax is the highest tax you can pay, which is another reason why when we do the planning, especially if somebody's not getting a match in a 401k, we say, you know what, it really makes more sense to just open up a brokerage account because you're going to pay a lower income tax or a lower tax than you would if you just saved it in the 401k alone, especially if you're not getting a match. That makes sense. Mm-hmm.
Okay, thank you.
Did that answer your question?
Yes, it did. It did.
Great question.
Now, Brandon.
Yeah.
How does this apply to entrepreneurs who have their own business, like the taxes?
Taxes. Okay. So in terms of a tax deduction for the insurance, this does not give you a tax deduction. Now you can, the interest on the loans, remember these loans we take out? That interest is tax deductible, just like any other type of interest on a loan is tax deductible for business purposes. And so let's say if you were going to use a strategy like, so this is how I use it in my business. Let me just show you this. Okay. All right. I'm also an entrepreneur. Got it. So this is my LLC, right? And so all my money comes into this LLC, right? Now, as part of this LLC, there's two members. I'm a member, and I own 5% of my LLC. And then I have a second member. And the second member is a business trust, and it owns 95% of the LLC. Now, when you're looking at a trust, the trust has three parties. It has a grantor, it has a trustee, and it has a beneficiary. Okay. The grantor is the person who creates the trust. The trustee is the person who controls the assets of the trust. The beneficiary is just the person who benefits from the assets of the trust. All right. Now, I don't want to go like too deep off into trust because that's just a whole nother hour-long conversation. But the type of trust I use, I'm the trustee of this business trust. So what does that mean? I've effectively still own 100% control of my LLC, but now I'm in a position where I can control my tax liability. So for example, let's say I made $1 million. All right, well, before I make the million, now I can't do this right now, but this is my plan. So I'm telling y'all because I got to wait another 6 years in order to be able to do this through one of my insurance policies, right? But I got a policy like I just showed you with them two, where I take this $1 million and I flow it into this account and then I flow it back into the business. And when I do that, I've captured the growth of about 3% year over year. Got it? So that's my operating expense. That's money I would spend on, let's say, paying employees, creating content. I don't really do like any advertising or nothing like that, but just whatever I need to pay for in the business, that comes out of the business account. So when that money comes back in, now I still got to pay taxes on it, right? Because it's money that hasn't been taxed. Let's say my deductions out of that million is 500,000, right? Okay. That means there's another 500,000 that's left over that would need to be taxed. And if it's a single member LLC, you're being taxed. You're actually being double taxed. All right. As a multi-member LLC, I now have the ability to pay 5%, or I'm actually responsible for 5% of the taxes on 500 grand. So 5% of that 500 is only 25,000. That's what I would pay my personal income taxes on, only 25,000. Now the business trust on the flip side of that is going to now be responsible to pay taxes on $475,000 of income. Okay. And technically a trust pays a lot higher tax bracket than an LLC, S Corp, or C Corp. They actually pay a 37% tax rate. However, a trust has a beneficiary. And because it has a beneficiary, it can take that money and distribute it to its beneficiary. It just so happens to be the beneficiary of this business trust is my family trust. Guess who the trustee is? The family trust is. Bam, that's me, beneficiary or trustee here, right? So now I'm just taking that 475 and now it's in my family trust. Now, who's the beneficiary in this family trust? Those are going to be my children. Bam. And what do my kids need? Transportation. They need a place to live. They need education, entertainment, all those things I get to pay for out of the trust funds. Y'all ever heard of trust fund babies? So trust fund just means it's kind of like you have funds, the business has funds, the trust has funds. And so I'm by trustee in charge of operating this trust, number one, to be profitable. And number two, I have to be responsible for taking care of the needs of the beneficiary, which is so happen to be those kids, right? And so things that are not normally deductible, like a mortgage, like a car payment, for a regular person, those things are deductible for businesses, right? You can deduct that stuff for businesses as tax write-offs. So now I'm effectively moving money from my business to my family. I'm actually using that income without having to pay any taxes on it because of how it's positioned. See, I don't own anything in my personal name. My trust owns everything. And trust, you can't really sue. Well, you can sue trust, but good luck with that if it's the right type of trust. The second thing is the taxes on it. I can control my taxes because I can effectively move money from one entity to the next. Now, within this family trust, I got 5 insurance policies. All my kids and my wife, they all got them. That same income, I can do that strategy I just showed you with Kenny and Michelle, where we're flowing money from policy A to policy B to policy C, and so forth, all off that same money, right? So from how you would use this type of strategy inside of a business is really to just really help manage cash flow. Number one, because if you're an entrepreneur, you have a lot of expenses. Usually your expenses are normally a lot higher than what you're gonna like take home in profit, right? So you want to be flowing that money through an account like that to be able to earn that spread on it. Hopefully that makes sense. Did I answer your question, Big Dog? Or
Yes,
just
sir.
give you ideas? Okay,
Yep.
right on.
And I know we have a question up, a hand up for a question in the chat.
Who we got? Let me see.
I think it's Miss Kayla.
Hey, Kayla. I think you're muted.
Fix it. Can you hear me okay?
Yep.
All right. Can we blow up the table, the spreadsheet? So I feel like this is too simple for people. I just feel like I ain't been living life right. So you mean to tell me we could pay $5,000 in every month? At what point are we removing money to put back into our own pocket? Like putting 5 in, taking that other percentage out, and just taking it, funneling it back in every month?
I know it sounds too simple, but it's literally that simple. It's that simple. Yeah.
Yeah, monthly.
It's like you can do monthly. If you have the means to do it like every other month or every quarter, then you could even do that. And when I say means, I know like let's say some businesses, they get lump sums of money. They might get 20 grand one month, 50 grand the next, and they already kind of know what their expenses are going to be for let's say the month or the year. And they can just take lump sums, drop it in the policy, and take out enough to cover their expenses for the next 3-4 months. And if they need to take out more, they can take out more.
And you can do those transactions at the same time.
You can. That's how I do mine. Yeah, I'll say, hey, I'll call my call it. Actually, I have mine on automatic, like monthly, so something's always going in there. It's kind of like it's almost like my automatic savings that I have that automatically goes in. But let's say if matter of fact, we doing this right now. Anthony just gave me $7,500. Was it yesterday? All right, tell us a little bit about that, because him and I are actually putting together. We getting some work done on our business as far as getting some automation and stuff done, and it's gonna cost us about 20 grand, like total to get it done, right? And so we've been knowing about this for a couple of weeks, actually a little bit longer than that. So what did you do, Ant? Like, where'd that 75 come from? You're muted. Or you might be on the phone or something.
There we go. Yeah. So instead of just earning the money and then handing him money for the business, what I did was just put the amount of money that I was going to pay for the business expense into the policy first, and then 3 to 5 days later, they let me know that, hey, that money's on the way into your bank account, and then it arrived earlier in the weekend. I seen it yesterday, so I just gave him cash, but that money is from the life insurance policy.
Mm-hmm. And then what I did is I took that cash, I put it in my bank account, and then I already took out money from my insurance policy. Like, that's already sitting there, right? So that's coming out as a loan. It's going to be direct deposited into my bank account. I'm going to take the 7,500 of that Ant gave me, and I'm going to just put that back in the policy. And I'm just
okay. And this is considered an IUL.
Hmm?
Yep.
And who do I get this from? Because I feel like we all could have been making a whole lot of money, and I just like my money to go places where it's making money, so I don't have to go exchange my time for money.
Good question. Great question. So this is my favorite example. When you hear IUL, that's just a product. No different than a chicken sandwich. Everybody with a fast food restaurant sells a chicken sandwich, don't they? But who got the best chicken sandwich? I'm gonna vote Chick-fil-A.
Chick-fil-A.
But who all got chicken sandwiches that are like Chick-fil-A? Popeyes came out with one. McDonald's got one. Burger King got one. Everybody got.
Now, Popeyes can get Chick-fil-A run for their money on their chicken sandwich. I'm just saying.
They do. So let's put it this way. My point is, I'm just trying to say that the IUL is just a product, right? But based on the type of product, did y'all know that Chick-fil-A and Burger King get their chicken meat from the same place? Like, seriously.
Nope.
They get their meat from the same place. But I would rather have a Chick-fil-A chicken sandwich over a Burger King chicken sandwich any day. And so that means that the seasoning, the preparation, how it's designed is really like what you're looking for. That's the expertise. Because like if you go on YouTube today and you Google IUL, man, you're gonna see so much stuff on IUL, you can get lost. Like straight up. You know, you're gonna see good stuff about it, you're gonna see bad stuff. All the bad stuff you're gonna see about it is because somebody went to an insurance person who they knew sold life insurance, and they say, hey, I saw this video of so-and-so saying I could put money in my insurance policy and do this. Can you do that for me? And they say, yeah, sure, because they so busy trying to make a sale that they ain't even really got an IUL for themselves. So and a lot of times, in a lot of cases, they'll just set up a product because they're just selling a product as opposed to selling a solution. You see what I'm saying? And so I say all that to say this. We only use like 2 companies for our design. Like, we don't got, there's probably some other companies that we can use for the design, but we comfortable with the 2 that we use now. And with our concept, we're able to put money in it that way and get the money out like that, because we have to reduce a lot of the surrender charges inside of the account, right? So a lot of the fees and stuff that you'll see in an insurance contract won't be there because we actually reduce our commission when we set up accounts like this. All right, in order to be able to make it work. If you like I said, if you do research, you won't see people talking about taking money out of a policy in within 30 days of opening it up, right? Because it just ain't something that most people would do. And even if they knew about it, some agents wouldn't be down to reduce their commissions after they spent a bunch of time and energy, let's say, putting something like that together. All right. So Brandon, why are you doing it? Well, I don't need the money. That's why. I like getting the money, but I don't need the money. That makes sense. And Anthony,
so I can cut you off. So I can put 36,000 tomorrow into my policy and borrow 190 the next month.
190,000.
Yeah.
So you can only borrow what you have in cash value. So think about if you have a home, you can only borrow your equity.
Okay.
You see, the house might be worth 500,000, but you can only get access to your equity in your house. Same thing here. Difference is here, you're taking your cash and you're putting it in the account and you're creating a lot of equity, like right up front, that you don't have to go to a bank and get approval for to get out. Like your cash is your credit.
Okay.
And
what makes this different than Prime America and all those companies who, they're trying to sell us? Like, you're not trying to sell us anything right now, but what's the difference?
It kind of goes back to the chicken sandwich situation. Go get a Burger King chicken sandwich, but if you want a certain quality, you're gonna have to go to a different company.
Yeah, I ain't got nothing bad to say about Primerica, but Primerica is a multi-level marketing group or company and an insurance agency, and they don't offer the type of products that we offer. They only do term life insurance, which term has its place. Like some term insurance, like something is better than nothing. But Primerica wouldn't be offering this. They actually talk bad about this because they don't know what they don't know. That's it. Good question, though. Good question.
Now, for people who got kids, I'm not sure if you mentioned it, like how can we borrow against our kids? Put a policy on our kids and make sure that policy grows.
Yep. The same thing I showed you with Kenny and Michelle. Just imagine that, just smaller numbers. It works exactly the same way for everybody, regardless of like how old they are. The things that we're looking for is the premium. Remember, we're not buying the death benefit. It's the premium. How much premium are we putting in? Think about your income. So did you know that your income is for your employer, your income is premium to them because they paying you premium to get a certain value out of you. Right? So your income is premium to your employer. When you pay your premium into an insurance policy, you want to think about your income, right? Technically, if you look, I know everybody just probably got done with their taxes last year. Look at how much you made, right? Whatever that number was, all of that money went somewhere. The first place it probably went to was to your checking account. That's premium. That's what it is. Got it? Now, you do need to be able to save. Okay, and what you can save is going to dictate how much premium.
And it looked like we had another hand up, Ronald. If you're free.
Yeah, I just got one question. Mm-hmm. Could I put this on my little cousin or somebody and then just do it like that? Since I'm like kind of older, I don't know if I can pass the physical and all that stuff.
You could potentially do that. However, remember, we're not buying the death benefit. So, for example, if your cousin is younger, and let's just say that the number was 50,000, you say, "Hey, Brandon, I need a policy for 50,000," and you put it on your cousin. All right, and let's say he's like 10 years younger and healthy. All right, his minimum death benefit might be, it's just concept now. Let's just say, for the argument's sake, that his minimum death benefit would be 500,000 if he put in 50. Right, but then let's say for you, if you put in the same 50, your minimum death benefit might only be 300,000. Right. So it's the same premium, right? It's both are the same. you would just be getting less death benefit. And we're not buying this policy for the death benefit. It just is kind of like oh, by the way, this is the death benefit. You know what I'm saying?
But how they feel about the question really is how they feel about the physical part. Do I still got to pass the physical and be in top notch shape, or just like little aches, arthritis type stuff? They don't care too much about type. That's what I'm trying to get to the feeling.
Oh no, man. They don't care about like all that stuff. Like there's you know, like typically you wanna be. I mean, of course, the better health you in, like the better chances and stuff like that. But what I would say is the biggest cause for somebody, let's say, get declined for like coverage or something like that, is if they had like a terminal illness like cancer, or they like, you can even get approved like if you have diabetes, right? As long as it's like controlled and it's been managed and your A1C is like low enough. You see what I'm saying?
Nah, because I'm close to 40. I'm just trying to see, like, I'm trying to make sure.
You young.
Yeah, you young, man. Most people, like, most of my clients are like yeah.
I can't believe he said he's old.
Yeah. Yeah. And then height and weight is the biggest one. Height and weight ratio. And Ann might know more about that. Like, what's the standard weight like for height and weight, if you can remember, just kind of off a chart? Because some people think, oh shoot, I'm overweight, but they still can. It's still like considered standard, like, which is the average.
Like, let's say if you're like 5'10", a standard rating would just be 261 pounds. That's pretty standard.
260?
Yep. You would still qualify for a standard rating.
Oh, okay.
Yeah, they're pretty lenient. They know. I mean, we are living in America, and diet here are a little over the top. So take that into consideration. So
yeah, and the height and the weight is the same for men and women. Mm-hmm. Yeah, good question. All right, so I got time for like a couple more questions, and I gotta get in here with these little girls and go play, I guess. All right. Is it Ronald? You got your hand raised?
Oh, that was the one that we just.
Thank you.
Okay, right on, Ronald, man. That was a great
question.
Any
other questions?
Asking it. Okay, all right. Well, it's been fun. Christine, I want to thank you again for inviting me on. I had a great time. Hopefully I was able to provide you guys some value. And man, I'm looking forward to it. Maybe next time we get together, we can talk about dive a little bit deeper into trust. You know what I'm saying?
Thank you so much. Oh, you do have a question. Nigel has a question.
What's up, Nigel?
No, I was wondering if you could put like a link in the chat or something. So where
I was just about to say that.
Yeah, I was gonna say drop your social medias and stuff in the chat.
Here we go. Yep, let's do that. And then
hey, thank y'all for y'all time too. Thank you.
Hey, you welcome.
Thank you. I appreciate it.
Thank
you.
Thank y'all for making it fun and not just sitting there.
That stuff was mind blowing, man. Mind blowing.
It's life changing. It's life changing. Yes, and this is how you really build generational wealth. Like Brandon said, it's like one of two ways of building wealth tax free. So if you're not utilizing this tool, then you at a disadvantage.
Yeah.
So if they want to get in contact with you, do you have your calendar so that they could book a call?
Yeah, I can. Hold on one second. So what I'll do, I'm gonna drop just my phone call link in here right now, because we actually we are super busy, if that makes sense, right? So we going out of town for like a business trip, so we won't be really able to like kind of like do any like meetings within the next couple of weeks, but we can do like phone calls and kind of go there, and then we can discuss like next steps from that point. I'm just trying to find the link here. Just give me 1 second.
So what's the time frame from them like executing a policy? I'm pretty sure that somebody's thinking that question.
I would say on average a month.
A month, yeah.
It's so similar to buying a house. Like once you know you want to buy a house, then first you start doing your research, then you got to get approved for the loan, right? So getting approved for the insurance, so that takes time. Then once you're approved, then you figure out, okay, well, how much do I want to invest? How much do I want to do? And we start that part after you get approved. It's kind of like you start.
I have a question.
Yes.
What if you have a current policy? I don't know if I missed that somewhere.
Okay. If you have a current policy, like it won't affect what you have going on right now. In terms of, like, let's say replacing a policy, we don't like to replace a policy unless it makes sense, because we gotta take a look at it and see like what it is, like assess it.
Okay.
All
right.
But if you have a policy, that's a good thing. That's a really good thing, for sure.
Okay.
All right.
I don't understand it, but if I could send it to you and you look over it, then
Right. I'll put my email in the chat
some years.
if you want to email.
Okay. All right, I'll do so. Thank you.
Okay, you're welcome.
Joy, I was the same
way.
Thank
you, Christina.
You're welcome, Joy. I was the same way. I didn't understand insurance either. And like before I found Brandon, we had insurance policies, and I didn't even know that we had term life insurance policy, and we had a $1 million policy, and it was cheap too. It was like $200. But once I found Brandon and the IUL, I noticed that the policy that I have was not building any cash value. So we were at a disadvantage and losing money every single month.
Right. I think that's where I'm at right now. Because I'm like, I was never told this with mine. So
yeah.
Okay.
So now we have a policy for me, my spouse, and my 3 children, and we do not play about it. It's like,
oh, that's good.
Yeah, you have to build generational wealth for your kids.
I agree. Thank you. Okay, thank you.
So good stuff, y'all. Good stuff. All right, I think that's it.